How do you make $50 million vanish without stealing it, laundering it, or setting off a single alarm? This was the impossible question haunting investigators when a retired Mafia accountant seemingly erased a massive fortune from the records, leaving behind nothing but silence and confusion. There were no missing bank balances, no suspicious transfers, no signs of fraud in the ledgers. Only a perplexing void where millions once were accounted for. This was not about guns or intimidation. It was a crime of precision, executed through the very systems designed to ensure transparency and trust. The man behind the disappearance was no ordinary criminal, but a seasoned accountant, someone who once managed the finances for one of the most notorious crime families. After decades in the shadows, he retired quietly, leaving behind a spotless record and a trail that led nowhere. Yet, what he left undone was far more disturbing than any typical theft. He manipulated the accounting frameworks themselves, exploiting accepted practices, audit assumptions, and procedural trust to make the money disappear on paper. The bank balances remained untouched, but the records told a different story, a story of compliance and normalcy that passed every review without question. Financial controls, designed to catch discrepancies and fraud, became his unwitting allies. Every ledger entry matched the expected norms. Every audit report was clean, and the internal controls that should have raised alarms remained silent. The very trust placed in accounting processes became the weapon that erased $50 million without a trace. No criminal act in the traditional sense could be identified. No unauthorized transfers, no forged documents, no hidden accounts. Instead, there was a labyrinth of legitimate entries and accepted procedures that led investigators in circles. As doubts grew within the organization, a slow realization dawned. There was nothing concrete to investigate. The financial trail was a dead end, the documentation a maze without an exit, and the responsibility diffused across multiple departments and systems built to protect themselves from scrutiny. When authorities finally stepped in, the money had ceased to exist in any meaningful form. The accountant had already stepped away, leaving behind a perfect puzzle with no missing pieces, no fingerprints, and no motive that could be proven. In this investigation, we will uncover exactly how trusted accounting methods and audit assumptions were weaponized to erase $50 million. Step by step, we will reveal the mechanism behind a financial disappearance so complete that it defied detection. This is the story of how accounting itself became the tool for one of the most sophisticated crimes ever recorded, a crime that left nothing behind to investigate. How do you make $50 million vanish without ever touching a dime, without laundering a cent, and without setting off a single alarm? This isn't the setup for a thriller. It's a true story that defies conventional understanding of crime and finance. The man at the center of this enigma is a retired Mafia accountant, a figure who wielded spreadsheets instead of firearms, audits instead of threats, and whose actions erased an enormous sum from the ledgers of organized crime with surgical precision. No gunshots, no underground vaults, no hidden cash stashes. Just silence. This is not about violence or intimidation. It's about the cold, meticulous world of accounting systems and financial controls. The mystery lies in how the money disappeared not through theft or fraud in the traditional sense, but through the manipulation of records so expertly executed that every external review came up clean. Auditors found no irregularities. Internal controls remained unbreached. The ledgers, the audits, the entire financial infrastructure reported nothing unusual. It was as if the money had evaporated, leaving behind only blank spaces where the $50 million should have been. The implications are staggering. If accounting, the backbone of financial truth, can be weaponized to conceal a crime of this magnitude, what does that mean for trust, oversight, and the very concept of financial accountability? How can standard procedures fail to detect what appears to be a complete erasure of funds? This was not a simple miscalculation or an accidental oversight. It was a deliberate, calculated disappearance executed by someone who understood every nuance of the system. In the following segments, we will dismantle the layers of this operation piece by piece. We will expose the exact methods used to rewrite the financial story without raising suspicion, revealing the vulnerabilities exploited in a system designed to prevent precisely such an act. Step by step, the mechanism behind this unfathomable disappearance will be laid bare, showing how precision and silence became the most powerful weapons in this unprecedented financial vanishing act. Within the intricate hierarchy of the Mafia, the accountant occupied a position of unique influence and subtle authority, often overshadowed by the more visible enforcers and capos. Unlike those whose power was asserted through intimidation or violence, the accountant wielded control through knowledge, precision, and an unyielding commitment to discipline. His role was not merely to balance ledgers or file paperwork. He was the architect of the organization's financial integrity, the silent guardian of its economic lifeblood. He earned his place through a combination of technical skill and unwavering discretion. Trust in this role was not given lightly. It was earned over years through demonstrated loyalty and an impeccable record of confidentiality. The Mafia's survival depended heavily on his ability to keep the books clean, or at least appear that way, while maneuvering vast sums of illicit money through a labyrinth of legitimate and illegitimate channels. His reputation was that of a man who could be counted on to execute long-term strategies without faltering or drawing undue attention. The accountant's value extended far beyond basic bookkeeping. He was deeply versed in both the criminal money flow and legitimate accounting principles, a rare and dangerous combination. This dual expertise enabled him to craft financial narratives that could withstand scrutiny from both law enforcement and internal audits. Every transaction, every ledger entry was meticulously planned to maintain plausible deniability and avoid triggering suspicion, a task requiring not only technical proficiency, but also a profound understanding of regulatory frameworks and financial behavior patterns. More dangerous than the enforcers, the accountant's power lay in his invisibility. While enforcers dealt in immediate threats and visible force, the accountant shaped the organization's future by managing its wealth and ensuring its sustainability. His influence was subtle but far-reaching. Decisions about investments, money laundering, and financial risk were filtered through his judgment. Unlike the enforcer's short-term tactics, the accountant was a strategist focused on longevity, understanding that the Mafia's true strength rested on stable finances and the ability to adapt over time. Gaining trust in such a role required a blend of personal integrity and strict adherence to discipline. He operated under a code of silence more rigid than any enforced by violence. Discretion was paramount. Leaks or careless mistakes could unravel entire operations. His work was isolated from the brashness of street-level dealings. Instead, he maintained a calm, methodical approach, never rushing, always anticipating future consequences. This long-term planning was crucial in an environment where sudden shifts in law enforcement or internal power struggles could jeopardize everything. Handling the books was an exercise in balancing two worlds. On one hand, there was the flow of illicit cash, proceeds from illegal activities that had to be disguised or integrated into the legitimate economy. On the other, the accountant had to comply, at least superficially, with tax laws, corporate regulations, and banking requirements. This balancing act demanded creativity and precision, simulating legitimate business activity while keeping the true origins of funds hidden. The accountant's role was akin to walking a tightrope, where a single misstep could provoke audits, seizures, or worse. His approach to finance was methodical and unromantic. There was no room for vanity or error, only a relentless focus on accuracy and risk management. His retirement was not an escape, but a calculated move within the broader strategy of the organization. By stepping back quietly, he avoided attracting attention to potential vulnerabilities in the financial system he had so carefully constructed. His departure was designed to ensure continuity, passing on a framework that would endure beyond his direct involvement, confirming his role as a visionary guardian rather than a transient figure. In the shadows of the Mafia's operations, The accountant's legacy was built on silence, calculation, and unwavering discipline, qualities that made him indispensable and formidable in ways that brute force never could. His retirement marked not an end, but a transition, a strategic repositioning within a game that demanded foresight and patience above all else. In the labyrinth of illicit dealings and hidden fortunes, accounting systems stood as the perfect stage for concealment, not because they were inherently vulnerable, but because their very design was rooted in order, trust, and repetition. These systems were forged to track money transparently. Yet paradoxically, that same transparency created an environment where subtle distortions could slip unnoticed. The accountant's domain thrived here, in the quiet spaces between numbers, where assumptions and consistency were the currency of credibility. At the heart of any business, legitimate or otherwise, lies the internal ledger, a detailed record of every transaction, every movement of money. It's a living document, updated constantly, reflecting income, expenses, assets, and liabilities. For most, it serves as a mirror, showing the company's financial health. But for those skilled in manipulation, it was a canvas for invisibility. By carefully adjusting entries, delaying recognition of income here, accelerating expenses there, the ledger could be shaped to tell a story that fit a desired narrative. This wasn't about blatant fabrication. It was about exploiting timing, interpretation, and the inherent complexity of financial flows. External audits, often seen as the watchdogs of truth, added another layer of apparent security. Independent auditors reviewed the ledgers, checking for compliance and accuracy. Yet audits operate on sampling and trust. Auditors rarely examine every transaction. They rely on patterns and consistency. When numbers align with past reports and expected results, auditors move forward with limited scrutiny. The system presumes good faith, an assumption rooted in the belief that businesses maintain honest records. This reliance on consistency rather than absolute verification created blind spots. If the ledger's narrative was steady and believable, subtle discrepancies could evade detection. Tax filings followed a similar path. Governments require businesses to submit detailed reports of earnings, expenses, and deductions. These filings are cross-referenced against internal records, but the process is largely automated and formulaic. Tax authorities depend on the accuracy of submitted information and the assumption that companies operate within the bounds of law and reason. Here, too, prior records set expectations. Sudden shifts in profits or losses invite questions, but gradual anomalies, carefully masked through small, incremental changes, rarely raise alarms. The system's reliance on historical data and predictable patterns made it susceptible to those who understood how to blend deception with routine. Compliance reviews, designed to ensure adherence to regulations and ethical standards, hinge on documentation and procedural checks. They scrutinize whether the proper forms were filed, whether controls are in place, and whether standards are met. But these reviews are procedural by nature. They verify if the right boxes are checked, not necessarily if the underlying reality is truthful. If paperwork is consistent and complete, compliance is presumed. This procedural trust, a cornerstone of regulatory frameworks, paradoxically opened doors for those who mastered the art of appearing compliant while bending the truth underneath. What tied these systems together was an unspoken pact, the expectation that businesses, auditors, and regulators all operated within a shared framework of honesty and consistency. This pact was built on assumptions that prior records were accurate, that patterns would continue, and that deviations were exceptions rather than a norm. The accountant who understood this pact could navigate its nuances, using the weight of established trust as a shield. The true vulnerability, therefore, was not in outright illegal acts or blatant fraud, but in the procedural trust that these mechanisms depended on. It was a trust so ingrained that it rarely questioned the subtle shifts beneath the surface, the small manipulations that, over time, could make millions vanish without a trace. And just as the shadows lengthened over these financial fortresses, It became clear that the greatest weakness was not what was done in plain sight, but what was quietly accepted as truth. The question lingering now was how to expose a system that thrived precisely because it was trusted. The disappearance of millions from ledgers without a single dollar physically moving was a masterclass in subtlety, an intricate dance of numbers that left no immediate trace of wrongdoing. On paper, everything remained pristine, balanced, and defensible. It was never about blatant theft or sudden, glaring discrepancies. Instead, the art lay in the slow, methodical erasure of value through legitimate accounting maneuvers that, when viewed individually, seemed perfectly reasonable. The cumulative effect, however, was an almost imperceptible depletion of wealth, hidden beneath layers of complexity and compliance. One of the primary tools in this financial sleight of hand was reclassification. Assets or liabilities were shifted between categories, sometimes moving from one balance sheet line to another, blurring the true nature of what was held. A loan might be reclassified as a contingent liability or a receivable recategorized as an investment, altering the apparent liquidity or solvency without triggering alarms. These moves were always accompanied by thorough explanations, market conditions, shifts in strategy, or evolving standards, and thus avoided suspicion. The numbers themselves didn't vanish. They simply wore different disguises, making it harder to track the depletion of actual value. Offsetting entries played a similar role, providing a veneer of balance where value had quietly been drained. By creating corresponding debits and credits across accounts, the net figure appeared unchanged, yet the underlying reality was altered. For example, an overvaluation in one asset might be offset by a matching overstatement of a liability or a reserve. The financial statements remained balanced, the books closed without error. Auditors saw a perfect symmetry of entries, each with a plausible justification. The art was in ensuring that the offsets were legitimate, within the rules, and backed by documents that could stand up to scrutiny. Write-downs, too, became a strategic weapon rather than a mere acknowledgement of loss. Instead of sudden, large impairments that would raise eyebrows, the process was gradual and methodical. Assets were systematically written down over multiple periods, often justified by shifting market conditions or changes in estimates. This slow erosion masked the true scale of value loss. The narrative was one of prudence and caution, not desperation or fraud. In this way, the erasure was paced to align with external events and internal policies, ensuring each step was defensible, even commendable. Timing differences further obfuscated the trail. Income recognition, expense accruals, and provisioning were manipulated within the bounds of accounting standards to defer or accelerate the impact on profits and balances. By exploiting the flexibility inherent in these rules, the appearance of financial health was extended and the depletion of funds was spread out over time. Seasonal adjustments, estimates based on historical data, and conservative judgments all contributed to a shifting landscape where immediate losses were deferred, hidden in the fog of legitimate timing choices. What made these maneuvers effective was their foundation in accepted accounting principles and the strategic use of legitimate tools. Nothing was fabricated outright. No fake transactions were created. Instead, existing frameworks were stretched and interpreted to their limits, creating a labyrinthine trail that could be confidently defended under audit. The narrative constructed around these entries was coherent, consistent, and reinforced by documentation, expert opinions, and internal policies. It was a house of cards built with precision, designed to appear unassailable. Yet beneath this facade of compliance, the truth was a slow, deliberate vanishing act. The money wasn't stolen in a single stroke, but faded away incrementally, slipping through cracks created by reclassification, offsetting, write-downs, and timing. Each step was small enough to avoid detection, but together they compounded into a loss too significant to ignore. The real question wasn't how the money disappeared. It was how no one noticed it happening, piece by piece, over time. What remained to be uncovered was the full extent of this gradual erasure and who had the patience and cunning to orchestrate it so seamlessly. The disappearance of the $50 million did not happen overnight. It unfolded with the deliberate patience of a slow leak rather than a sudden rupture. Each extraction was minuscule in isolation, a fraction tucked away behind legitimate transactions, buried within routine financial activities so ordinary they barely registered beyond the daily accounting blur. Over months, then years, the erosion advanced quietly, almost imperceptibly, masked by a steady flow of numbers that seemed to confirm stability rather than signal decay. The pacing was critical. Withdrawals and adjustments were strategically spaced, each amount carefully calibrated to remain within thresholds deemed inconsequential by automated systems and human reviewers alike. Rather than drawing attention, these incremental shifts blended seamlessly into the ebb and flow of normal business operations. The financial statements, though subtly distorted, continued to reflect plausible growth or consistent performance, preserving the illusion of normalcy. This fragmentation of the loss into countless small pieces meant that no single transaction was large enough to raise suspicion, and the cumulative effect was lost in the noise of everyday commerce. Audits, typically the final checkpoint for catching irregularities, passed without incident. The internal and external auditors operated under standard protocols. Their reviews focused on major discrepancies and compliance issues flagged by predefined criteria. Since the discrepancies were diffused in small amounts and cleverly concealed within legitimate accounts, the red flags never triggered. The audit trails appeared intact, and the supporting documentation was meticulously fabricated or subtly manipulated to match expected patterns. Each review, far from uncovering anomalies, instead reinforced the false normality. Reports repeated affirmations of sound financial health, further embedding the illusion that finances were robust and well-managed. The controls in place, while seemingly rigorous, were exploited through a deep understanding of their limitations. The orchestrator's familiarity with the company's internal systems and reporting cycles allowed for precise timing and distribution of the missing funds. Checks and balances were circumvented not by brute force, but by exploiting procedural blind spots, gaps where oversight was routine rather than rigorous. This orchestrated erosion was so well integrated into the reporting rhythm that even whistleblowers found it difficult to identify a clear pattern of wrongdoing. The loss was, in effect, camouflaged by the very systems designed to prevent such occurrences. In addition, there was a subtle psychological element at play. The steady stream of seemingly positive reports lulled managers and stakeholders into complacency. Confidence in the financial processes grew with each review cycle that confirmed expectations, inadvertently lowering vigilance. The convergence of fragmented losses, routine financial noise, and reinforcing audits created a feedback loop that normalized the abnormal, making the disappearance of tens of millions feel like an impossibility rather than an unfolding reality. Yet, beneath this veneer of normality, an undercurrent of doubt began to stir among a few observant individuals. Small inconsistencies, minor deviations from expected patterns, and the occasional unexplained ledger adjustment planted seeds of internal curiosity. These observations, however, were often dismissed or rationalized within the broader context of complex financial operations and market fluctuations. The inertia of established trust and procedural confidence delayed deeper inquiry, allowing the erasure to continue unabated. Ultimately, the full scope of the disappearance remained obscured until internal curiosity finally overcame the layers of routine acceptance. By then, the trail had grown cold, and the opportunity to intervene in time had passed. The slow, steady fading of $50 million into the financial background was not just a story of lost money, but a testament to how systemic complacency and procedural gaps can quietly enable monumental losses hidden in plain sight. The first stirrings of doubt began almost imperceptibly, like a faint tremor beneath a calm surface. A junior analyst, tasked with routine cross-checks, noticed an unusual pattern in the ledger entries. small discrepancies in timing and amounts that didn't quite align with expected cash flows. At first, these anomalies seemed minor, easily explainable by the complex web of transactions the company routinely handled. Yet, curiosity nudged the analyst to dig a little deeper, quietly flagging the inconsistencies in internal notes rather than raising alarms outright. As days passed, a few more staff involved in the reconciliation process began to sense something was amiss. However, the culture within the finance department was one of strict adherence to deadlines and trust in established procedures. Requests for additional reviews were met with polite delays. Supervisors cited workload pressures and the need to prioritize closing monthly reports. The analyst's initial concerns were met with gentle reassurances that the documentation had been vetted and that there was no cause for alarm. The paperwork, on the surface, was flawless. Every transaction had corresponding invoices, approvals, and signatures. The digital trails matched the physical records. Independent auditors had previously signed off on the accounts without issue. These factors collectively created a formidable wall of credibility. When questions arose, they were often neutralized by referencing the thoroughness of the internal controls and the legitimacy of the documentation. The phrase "audit trail intact" became a quiet mantra, repeated to soothe uneasy minds. In truth, the company's financial mechanisms had been designed for efficiency and compliance, not for catching subtle manipulations that exploited procedural loopholes. The system depended heavily on trust and assumed good faith among employees, and that assumption was beginning to be weaponized by those who understood its limits. Each piece of paper, every digital entry, was part of a carefully constructed facade that obscured the true flow of funds. Requests for additional scrutiny were often deferred, sometimes due to bureaucratic inertia, other times because raising too many questions risked unsettling clients or investors. The analysts who wanted to push further found themselves isolated, their concerns whispered in corridors but never formalized in meetings. It was easier to accept the appearance of order than to confront the possibility of systemic failure. If you're intrigued by how hidden cracks in complex systems can lead to catastrophic outcomes and want to explore more real investigations into organized crime, financial blind spots, and invisible crimes, consider subscribing. Our stories reveal the unseen forces shaping our world, one investigation at a time. Behind the calm exterior, the reality was far more troubling. The inconsistencies were not random errors, but symptoms of a carefully orchestrated extraction. The documentation that seemed so robust was deliberately crafted to withstand scrutiny, to mislead even the most diligent reviewers. Each delay in review, every softened question, was part of a broader strategy to buy time and preserve the illusion of normalcy. By the time the doubts began to coalesce into a clearer picture, the damage was irreversible. The opportunity to recover the vanished funds had slipped beyond reach, swallowed by layers of obfuscation and procedural complacency. The internal struggle to confront the truth had been quietly overwhelmed by the weight of routine, and the silent disappearance of millions was already a fait accompli, hidden not just from external eyes, but from those within who might have acted too late. As external auditors and investigators delved into the financial labyrinth, their initial expectations of uncovering a coherent trail of transactions were quickly tempered by the stark reality reflected in the documentation. What should have been a detailed ledger of income, expenses, transfers, and balances instead presented a fragmented and inconsistent record. The files, far from revealing a transparent flow of funds, seemed intentionally disjointed, with numerous entries lacking corroborating evidence or appearing simply fabricated. This absence of a verifiable money trail marked the first indication that standard investigative approaches would be insufficient. The records themselves exhibited glaring gaps. Bank statements were missing or incomplete. Internal memos refer to transactions that left no corresponding paper trail. Accounting entries showed suspiciously rounded figures that defied typical financial behavior. These irregularities were not mere clerical oversights, but pointed toward deliberate obfuscation. Attempts to cross-reference invoices with purchase orders or supplier confirmations yielded little. Many vendors listed were unverifiable or non-existent. Where one would expect an audit trail, a clear sequence linking source funds to expenditures, there was instead a series of dead ends. Efforts to reconstruct the financial flows were further hindered by systemic limitations. The company's record-keeping policies lacked standardization, allowing for inconsistent documentation practices that complicated verification efforts. Digital records, where available, had been stored on outdated or unsecured platforms, some corrupted beyond retrieval. In many cases, crucial files have been deleted or overwritten, and backups were either non-existent or incomplete. This absence of reliable archival material effectively prevented investigators from establishing a chronological and factual sequence of events. Legal constraints compounded these difficulties. Privacy laws and banking secrecy regulations restricted access to certain financial accounts, particularly those held in offshore jurisdictions with stringent confidentiality protections. While subpoenas and mutual legal assistance treaties offered some avenues for information gathering, the process was slow and often met with bureaucratic resistance. Even when access was granted, the complexity and opacity of international financial instruments meant that the investigators could only piece together fragments rather than a comprehensive picture. The transnational nature of some transactions added layers of complexity, with multiple intermediaries and shell entities obscuring ultimate ownership and control. Moreover, the organizational culture had fostered an environment where accountability mechanisms were weak or circumvented. Internal controls designed to monitor and validate financial operations had been either inadequately implemented or deliberately bypassed, allowing for extensive manipulation of accounts. The auditors encountered numerous instances where ledger entries appeared to be adjusted retroactively, making it impossible to determine the original amounts or the rationale behind these corrections. This further eroded the reliability of the data and compromised the feasibility of an accurate reconstruction. The cumulative effect of missing documents, altered records, and legal hurdles left investigators with an incomplete and unreliable dataset. Conventional forensic accounting techniques, reliant on tracing paper trails and identifying transactional patterns, were rendered ineffective. Without verifiable evidence, any attempt to quantify the extent of the financial erosion or to identify the precise mechanisms of diversion remained speculative. The elusive nature of the financial misconduct effectively stalled the investigative process. This impasse forced a critical shift in approach. With the absence of a tangible money trail, attention turned toward the human element, the individual responsible for maintaining the books and orchestrating the financial narrative. The focus increasingly centered on understanding the methods employed to fabricate and manipulate records, as well as the motivations behind such actions. In tracing the shadows left within the ledgers, investigators sought to unravel the role of the man whose expertise and control over the financial documentation had been central to the concealment. The accountant's withdrawal unfolded with deliberate precision, marked by a series of methodical steps that left no room for ambiguity. It began with a formal notice submitted to the board, signaling his decision to retire. The language was unequivocal, a firm declaration of stepping away from all responsibilities related to the financial operations. No hints of hesitation or second thoughts accompanied the message. The retirement was effective immediately, demonstrating a clear intent to sever ties without prolongation. Following this announcement, access to all financial systems under his purview was promptly terminated. Credentials, passwords, and digital keys that had once granted him unfettered entry into the company's fiscal resources were revoked in a single, coordinated action. Logs confirmed that his last login occurred mere hours before the access restrictions took effect, reinforcing that the process was controlled and anticipated rather than abrupt or forced. This cessation of system access was comprehensive, covering internal databases, external software platforms, and any remote connections previously authorized. Simultaneously, the roles and titles he had occupied were officially closed out. Records indicate that his position was not reassigned or filled by another employee immediately. Instead, it was dissolved altogether. Correspondence with human resources and senior management reveals a clear directive to conclude all duties associated with his office, with no transitional period or handover. The absence of an interim replacement underscores the finality of his departure. Additionally, all contractual agreements and service-level commitments related to his work were formally terminated or archived, leaving no active engagements tied to his name. In the aftermath of these steps, the accountant's presence vanished from public and internal records alike. Database entries that once highlighted his involvement in financial reporting were archived, and any references to him in ongoing projects or communications ceased abruptly. This erasure was systematic and thorough, covering both electronic and paper trails. Investigators noted that no subsequent documents bore his signature or annotations, confirming that his exit was not only declared but fully enacted. The nature of this disappearance was unmistakably calm and orderly. There were no signs of distress, conflict, or external pressure in the documentation surrounding his exit. The absence of emergency meetings, sudden resignations from peers, or crisis communications points to a retirement planned well in advance. The accountant's final days on the record were marked by routine activities rather than last-minute attempts to conceal or retrieve information. His withdrawal did not trigger alarms or irregularities. Rather, it was a quietly executed exit, as if closing a chapter with careful intent. Given the meticulous orchestration of this departure, one must consider the extent to which the process had been prepared behind the scenes. The seamless coordination between notifying leadership, revoking access, closing roles, and erasing his footprint suggests a timeline extending well before the official retirement date. How long had the accountant been laying the groundwork for this exit? The investigation into the erased funds quickly reached an impasse, largely because the trail of evidence was deliberately obscured at multiple levels. Despite the significant sums involved, no concrete link could be drawn to any individual, including the accountant whose departure coincided suspiciously with the disappearance of money. This absence of direct evidence was not merely a matter of luck or oversight, but seemed to stem from a careful orchestration designed to exploit both legal standards and the inherent challenges in proving intent. One of the core difficulties was the high threshold required to establish criminal liability, particularly in financial crimes. Legal standards demand not only evidence of the act, actus reus, but also a demonstrable intent, mens rea, to commit wrongdoing. In this case, while the disappearance of funds was undeniable, there was no irrefutable proof that the accountant had knowingly authorized or participated in their erasure. The records themselves had been systematically altered, yet none contained a signature, a timestamp, or an electronic fingerprint that could be unequivocally tied to him. Without this, prosecutors faced the insurmountable challenge of demonstrating beyond a reasonable doubt that he had acted with fraudulent intent. Moreover, the nature of the accountant's role inherently involved access and authority over the records and transactions, which blurred the lines between legitimate duties and illicit actions. The shared responsibility within the finance department meant that multiple individuals had overlapping access privileges and could have, theoretically, manipulated the records. This collective involvement provided plausible deniability not only for the accountant, but also for others in the chain of command. The internal controls and approval processes were designed to distribute accountability, effectively insulating any single person from being solely responsible. This diffusion of responsibility became a critical factor in thwarting any attempt to single out the accountant as the culprit. Adding to the complexity was the absence of any whistleblower or insider testimony implicating him directly. Despite the obvious irregularities, no colleague stepped forward with information indicating knowledge of wrongdoing. This silence might have been a result of loyalty, fear, or simply a lack of incriminating observations, but deprived investigators of the circumstantial evidence often crucial in financial crime cases. In the absence of such testimony, the case rested entirely on the documentary trail, which, as noted, was meticulously sanitized. From a procedural standpoint, the erasure of records was executed with such precision that forensic audits failed to uncover any residual metadata or backup files that could have indicated tampering. The IT systems, which under normal circumstances maintain logs of changes and deletions, showed no anomalies during the relevant period. This absence pointed to either an insider with intimate knowledge of the systems or an unprecedented level of premeditation and technical expertise. Either scenario complicated the attribution of guilt, as it introduced reasonable doubt about who could have orchestrated the deletion. The legal principle of innocent until proven guilty stood firm throughout the investigation. Without concrete evidence establishing intent, motive, or direct action, the authorities could not justify charges against the accountant. Prosecutors acknowledged that circumstantial evidence and suspicion alone were insufficient to meet the burden of proof required in criminal proceedings. Filing charges without this foundation risked dismissal in court or, worse, wrongful conviction. Ultimately, the case exemplified how sophisticated manipulation of financial records, combined with distributed access and a lack of clear intent, can create an impenetrable barrier against legal accountability. The accountant's meticulously planned exit, coupled with the erasure of digital footprints and the absence of incriminating evidence, left authorities with no viable path to tie the missing money to him or any other individual. As a result, the investigation closed with no charges filed, highlighting the challenges law enforcement faces in unraveling shadow crimes where the visible trail has been deliberately erased. The unraveling of this case leaves a stark imprint on the landscape of financial oversight and organized crime investigations. What once appeared as a straightforward disappearance of funds transformed into an elaborate void, an absence so complete it defied the very mechanisms designed to detect and disrupt illicit activity. The accountant's exit was not merely a flight from culpability. It was a calculated erasure of existence within the digital and bureaucratic frameworks meant to safeguard transparency. This case exposed a chilling reality. When the data trail is systematically wiped clean, the structures tasked with accountability become powerless, revealing critical vulnerabilities exploited by those who operate in the shadows. Despite exhaustive efforts, the investigation hit an impassable wall, underscoring a systemic failure rather than an isolated lapse. The inability to secure concrete evidence or establish a definitive link between the vanished money and any individual did not reflect a lack of will or diligence, but highlighted the inadequacy of existing tools and protocols. Financial oversight agencies, reliant on trails of transactions and digital footprints, found themselves navigating an invisible maze where each lead dissolved into nothingness. Traditional investigative approaches, designed for crimes with tangible evidence, faltered against a strategy rooted in absence and deception. This case serves as a stark reminder that organized crime's evolution is outpacing regulatory and enforcement mechanisms. The manipulation of digital records and administrative systems to create voids rather than traces shifts the paradigm of criminal activity. It challenges the foundational assumptions about how illicit operations can be detected and dismantled. Here, erasure is more than concealment. It becomes an active weapon, rendering the stolen funds effectively untraceable, destabilizing the very premise of accountability. The takeaway is clear and unsettling. The system's reliance on visible data and transactional footprints is a critical Achilles heel. Without adaptive frameworks capable of addressing the strategic erasure of information, investigations into shadow crimes will continue to stall, allowing the architects of these voids to operate with near impunity. This case is not just a story of missing money, but a glaring exposure of systemic weaknesses that demand urgent attention and innovation. If this exploration into the dark intersections of finance and organized crime has compelled you, make sure to like and subscribe for more deep dives into cases where the lines between law and shadow blur. We want to hear your thoughts. Do you believe erasing money holds more power than simply stealing it? And which Mafia or Yakuza system-based case should we tackle next? Drop your comments below and join the conversation as we uncover the unseen battles that shape our world.